Have you ever been cruising down the highway and suddenly found yourself stuck behind a massive truck? That looks like it could tow a small apartment building? The kind with chrome that blinds you in the sun, leather seats that probably cost more than your monthly rent, and a dashboard that could double as a cockpit for a private jet. You glance over and think, there's no way the driver makes enough money to justify this. And yet somehow they do. Or at least, they appear to. This is a phenomenon millions of Americans are participating in every single day, and it's creating one of the most quietly shocking shifts in personal finance in decades. My name is Bem, and I've spent way too many hours thinking about money debt and the curious ways people justify spending more than they arguably should. Today, we're diving into a question that might seem absurd at first. How are ordinary people driving vehicles that cost more than most houses without being wealthy? And the answer isn't as simple as people are bad at math. It's a combination of psychology, finance tricks, and clever marketing that's turned a vehicle into a status symbol and a long-term financial trap at the same time. Let's start with the numbers. Over the past decade, car payments in America have quietly ballooned to levels that would have been considered insane just 10 years ago. The average new car payment in the US now sits around $700 per month, and that's for a standard car, not a luxury SUV or a monster pickup. Trucks and SUVs, which dominate the American market, are even more extreme. Monthly payments often exceed $900, and $1,200 payments are far from unheard of, spread over the life of a typical 6 to 8 year loan. These vehicles cost more than $80,000, and that's before you even consider insurance, maintenance, and fuel. Yet millions of Americans are signing on the dotted line every single month. And who are they? They're not tech millionaires or finance moguls. They're teachers, nurses, office workers, mechanics, people with perfectly normal jobs who somehow make the numbers work or convince themselves that they do. So how is this happening? The most obvious culprit is loan structure. Remember when a car loan lasted 3 years, maybe 4 if you really stretched it? Those days are gone. Today, loans of 6, 7, or even 8 years are the norm. Some lenders are experimenting with 10-year loans, which is basically like taking out a mortgage on a vehicle. The appeal is obvious. Stretch a $60,000 truck over 8 years instead of 4, and the monthly payment drops from $1,500 to around $900 suddenly. That truck seems manageable. And that's exactly what buyers focus on. The monthly number, not the total cost. Here's the catch. Longer terms increase total cost dramatically. 4-year loan, a $72,000 total. 8-year loan, or $86,000 total. That's $14,000 extra just for having a smaller monthly payment. And because vehicles depreciate quickly, by year 5 or 6 of an 8-year loan, many owners owe far more than the car is worth. This creates negative equity, trapping buyers in debt and forcing them to roll over payments into newer vehicles. A vicious cycle that dealerships happily encourage. Another factor is the rise of definancing and other promotional interest rates. Walking into a dealership, you'll see signs offering what APR for qualified buyers. Sounds like free money, right? Not exactly. These deals are tightly controlled. Only buyers with excellent credit usually qualify. The cost is often baked into the car's price. Shorter terms mean the deal isn't available for extended loans for most buyers. The deal just shifts the cost elsewhere, or masks it with clever marketing. Meanwhile, regular buyers end up paying higher rates over longer periods, sometimes without realizing how expensive it actually is. The trade-in game is another key piece of the puzzle. Imagine someone buys a new car on a 7-year loan. After 3 to 4 years, they want a newer model. Problem: the car is underwater. They owe more than it's worth. The solution? Roll the negative equity into a new loan for an even more expensive vehicle. The cycle continues. Suddenly, people are paying for multiple cars they no longer own, with debt compounding every few years. Dealerships love this system because it creates long-term customers. Buyers feel trapped, so they stay in the cycle instead of walking away. Here's a critical point. People spend huge sums on cars because society tells them it's acceptable. If someone spent $200 a month on coffee or clothes, friends would probably stage an intervention. But cars? That payment is normalized because vehicles are essential, aspirational, and tied to identity. Marketing reinforces this. Ads don't sell cars. They sell lifestyle. Trucks aren't just for hauling. They're a statement of rugged independence, success, and reliability. A vehicle isn't transportation. It's a reflection of you. And once spending is tied to identity, rational financial analysis often takes a back seat. Even with extended terms and emotional justification, monthly payments of $700, $1,200s are huge for most households. How do people fit them in? Cutting expenses elsewhere, smaller apartments, fewer vacations, cheaper food, delaying savings, taking on extra work, driving for Uber, delivering food, or picking up weekend jobs to cover the car. Borrowing from the future, early retirement withdrawals, 401k loans, or home equity loans. Credit card juggling. Putting gas, maintenance, and insurance on high-interest debt. On paper, the payment is affordable, but the rest of life gets squeezed, creating stress and long-term financial risk. Even for buyers who calculate monthly payments carefully, the real cost of ownership is often underestimated. Consider a $55,000 truck. Loan, $800 month over 7 years, $67,000. Insurance, on $250 month, $21 in fuel, $350 month, and $29 maintenance and repairs, and $15,000 plus. Total, over $130,000 for a vehicle that might be worth $15,000 in 7 years. That's not transportation financing, it's wealth destruction. Meanwhile, investing that same $800 month in a simple index fund could yield over $70,000 in the same period. The opportunity cost is massive. Once someone commits to a high payment, the psychological barrier becomes huge. Downsizing feels like failure. Driving a cheaper car feels like social demotion. People defend their purchase with the same passion they defend family decisions. This is what I call automotive Stockholm syndrome. The vehicle becomes both a status symbol and a captor, making rational decisions difficult. Dealerships know this. Sales tactics are engineered to overcome objections. Worried about payment? Extend the term. Nervous about reliability? Add an extended warranty. Concerned about depreciation? You'll trade in a few years anyway. By the time the buyer signs, they're emotionally invested, financially committed, and socially rationalized. The situation gets even more extreme for households with multiple cars. Many families own more cars than drivers, each with its own loan, insurance, and maintenance schedule. Dad, work truck. Mom, SUV for kids. Teenager, first car. Combined monthly payments can easily exceed housing costs, and the complexity creates its own stress. People celebrate keeping all the payments current rather than questioning whether they should have all those vehicles at once. Insurance on a $60,000 truck is not trivial. Add comprehensive collision and gap coverage, and monthly costs easily exceed $200 per vehicle. For households with multiple expensive vehicles, insurance alone can hit $500 a month. Maintenance is another surprise. Modern trucks have complex engines, electronics, and emission systems. Simple repairs like brakes can cost $800 to $200. Major repairs like transmission or engine issues? $5,000, $10,000. Many buyers lack emergency funds, so they rely on credit or loans, deepening the cycle of debt. Fuel costs are no joke either. A truck averaging 15 mpg with a normal commute can easily cost $400 a month, climbing higher for weekend trips or road trips. So why do ordinary people drive cars they technically can't afford? Because the system is designed to make it seem possible. Long loans, marketing, psychological attachment, and creative budgeting allow buyers to manage monthly payments even when total costs are astronomical. It's a careful orchestration of extended loan term, promotional financing trade in cycles, and negative equity, emotional attachment and social pressure, creative personal finance juggling. At the end of the day, people aren't breaking laws or cheating the system. They're participating in a modern financial circus, and sometimes they don't even realize how tight the rope is until they're dangling over the edge. Next time you see a $70,000 truck barreling down the highway, remember, the person driving it may not be wealthy. They may be cutting corners elsewhere, juggling payments, or sacrificing long-term security for short-term satisfaction. And maybe, just maybe, that reliable used car in your driveway starts to look a little smarter. Cars are important vehicles, get us from A to B, but when they become a lifestyle purchase financed over a decade, with compounding hidden costs, it's no longer about transportation. It's about debt with wheels.